What if I told you the most popular way to start trading is also the fastest way to guarantee you'll fail? We've all seen the fantasy, the promise of quick profits, tiny risks, and total control. Sitting at your screen, executing dozens of trades a day, it feels like real action. It feels like skill. But that feeling is the most dangerous part of the entire equation. It's the perfect bait. The cold, hard truth that the online gurus and course sellers will never admit is this. For the vast majority of retail traders, scalping is not a viable strategy. It is a psychological and mathematical trap, meticulously baked into the very fabric of the modern electronic market. This system isn't designed to help you make money on a 1-minute chart. It's designed to transfer your capital to someone else's pocket, one tiny, precise cut at a time. Think about the attraction. Why does everyone almost instinctively gravitate to the 1-minute or 5-minute chart when they begin? Because it feels safer. The stop loss is just a few pips away. The feedback is instant. You get the adrenaline of a decision and its outcome within moments. This creates the powerful, addictive illusion of control. You believe you're minimizing risk by being in the market for only seconds or minutes. But you're not minimizing risk. You're maximizing your exposure to the market's most ruthless predators and its most unforgiving arithmetic. That instant feedback loop is a liar. It convinces you that you're learning, that you're reacting to the market. In reality, you're often just reacting to random noise, to the meaningless flicker of price action in a vacuum, devoid of any higher time frame context. The market on these micro time frames is a different beast entirely, a chaotic arena dominated by algorithms fighting other algorithms over fractions of a cent, where the retail trader is simply collateral. So, before we even dive into the mechanics of spread, commission, or market structure, you must understand this foundational point. Your initial attraction to scalping is likely based on an emotional need for action, control, and rapid validation, not on a strategic assessment of a proven edge. And the entire ecosystem, from the platforms to the order books, is optimized to exploit that very need. This is the hook. What follows is the slow, steady pull of the line, powered by 3 silent killers that operate on every single trade you place. Let's move from the psychological trap to the mathematical certainty. This is where the fantasy crashes into immutable numbers. The single greatest hidden predator in scalping isn't volatility or a bad entry. It's the transaction cost. Specifically, the spread and commission. These are not minor fees. They are the house edge of the high-frequency trading casino you've decided to play in. Every single time you enter a scalp trade, you start at a loss. If the EUR/USD spread is 1 pip and you buy at the ask price, the price must move 1 full pip in your favor just for you to break even on the trade. That's before any commission to your broker. In a slow market, that 1 pip move might be the entire average range of a 5-minute candle. You are literally fighting to overcome a built-in handicap before you can even think about profit. Now amplify this by the very nature of scalping. High frequency. A swing trader might take 5 trades a month, battling this spread 5 times. A scalper might take 5 trades in an hour. Do the math. If you take 50 trades a day with an average spread plus commission cost of 1.2 pips per round trip, you have to generate 60 pips of profit per day just to cover your costs. Not to make money, just to reach zero. This creates a monstrous break-even hurdle that most strategies simply cannot overcome in the long run. This is the brutal arithmetic that demolishes scalping accounts. You might have a strategy that is 60% accurate, which is excellent, but if your average winning trade is 5 pips and your average loss is 5 pips, you seem to be in a good place. However, you must now subtract 1.2 pips from every single trade, win or lose. Your 5-pip win becomes a 3.8-pip net win. Your 5-pip loss becomes a 6.2-pip net loss. Suddenly, your profitable edge evaporates. Your 60% win rate strategy is now a losing strategy, thanks solely to transaction costs. Think of it like this. You are a runner trying to win a sprint, but you have to start every race 3 feet behind the starting line. Sometimes you're so fast you overcome it, but over dozens of sprints, that disadvantage guarantees you will lose. The spread and commission are your 3-foot deficit. They are a silent, guaranteed drain that transforms statistically break-even strategies into losers and turns winning strategies into marginal, stress-filled grinds where you battle for every 0.1 pip. This is the first concrete pillar of the trap. You are not just trading the market, you are trading against its built-in cost structure. And on a micro time frame, that structure is the dominant force. Now that you see the mathematical hurdle, let's identify your real opponent. When you place a scalp trade, who is on the other side? In your mind, you're competing against other traders like yourself, all analyzing the same tiny chart. This is the second grand illusion. In the digital arena of micro timeframes, your primary opponent is not another retail trader. It is a liquidity-providing algorithm operated by a market maker or high-frequency trading firm. This is the critical, invisible mechanics of modern order books. When you click Buy with a market order, as most scalpers do seeking speed, you are not hitting some nebulous market. You are immediately buying from the lowest available sell ask limit order sitting in the order book. A massive portion of those limit orders are placed there systematically by these algos. Their goal is not to predict direction. Their goal is to earn the spread by constantly offering to buy at the bid and sell at the ask. Think of it as a poker game where you must bet every hand, but your opponent can choose whether to play or fold after seeing your move. You, the scalper with a market order, are the impatient player who bets every time. The algo with its limit orders is the patient player who only acts when the odds are in its favor, when your market order hits its price. It profits from the spread, the difference between its buy and sell price, with near-perfect consistency. Your win or loss on the price movement is almost secondary to its business model. Furthermore, these algos have a monumental structural advantage: colocation and speed. Their servers are physically housed within the exchange's data centers, giving them execution speeds measured in microseconds or nanoseconds. Your order, traveling from your home PC through your broker's server, arrives hundreds of times slower. In the world of scalping, where price changes in sub-second intervals, this means the algo can adjust its limit orders or execute trades based on new information long before your order even arrives. You are bringing a knife to a photon-speed gunfight. This creates a devastating dynamic. The algo sees the flow of incoming market orders. It can sense a surge in buying pressure from retail scalpers and can instantly raise its asking price or pull its sell orders entirely, causing you to experience slippage, getting filled at a worse price than you expected. It can also see where clusters of stop-loss orders are likely to be, just below a recent low for longs, and nudge the price there to trigger a cascade of market sell orders, which it can then buy at a discount. You are not just trading. You are being farmed for your predictable behavior by a system designed to capitalize on it. This is the true landscape of the scalping battlefield. The final core pillar of the scalping trap is the most important to understand for your own sanity. On the lowest time frames, you are not trading meaningful market signals. You are trading pure, unstructured noise. This is the fundamental reason why scalping feels so chaotic, why setups seem to work 1 minute and fail identically the next, and why consistency feels perpetually out of reach. To grasp this, you must understand market structure, real trends, genuine accumulation and distribution, the strategic moves of institutional smart money. These phenomena play out on higher time frames, the 1-hour, 4-hour, and daily charts. This is where significant volume flows, where major support and resistance are established, and where the broader narrative of an asset's value is debated. The moves you see on a 1-minute chart are most often just the mechanical byproduct or the microscopic vibrations of those larger decisions. Imagine a giant football stadium from a glimpse view, the daily chart. You can see the overall flow of the game, which team is attacking, and where the play is heading. Now imagine you are an ant on the shoe of a single player, the 1-minute chart. You're experiencing violent, random-seeming jerks, stops, and turns, Trying to predict the player's next move based solely on the vibrations you feel is impossible. That is the scalper's dilemma. You are the ant, reacting to localized chaos, utterly blind to the game. This noise is amplified and weaponized by the very algorithms we discussed. They create false breakouts, rapid stop hunts, and whip-like reversions that have no higher time frame significance. They exist purely to harvest the liquidity of other algorithmic orders and reactive retail traders. When you scalp, you are entering a battlefield where 90% of the movement is meaningless sound and fury, and your job is to somehow find the 10% that isn't. It's a game of finding patterns in static. This leads to the ultimate psychological blow, skill delusion. Because price moves so rapidly, you can attribute any win to your brilliant analysis and any loss to bad luck or a momentary glitch. This prevents the crucial learning that comes from higher time frame trading, where cause and effect are more clearly linked, and your edge can be objectively measured over time. On the scalp chart, you never truly learn, you just react forever. You trade the exhausting, soul-crushing chaos of the market's surface, never its deeper, more stable currents. If the game is so rigged, who wins? This is the most revealing question. Your losses from scalping do not vanish into the ether. They are systematically transferred to a small group of entities perfectly positioned to profit from the high-frequency chaos. You are not just losing, you are funding a highly sophisticated industry built on your predictable behavior. The primary beneficiaries are, as outlined, the liquidity providers and market makers. Their profits are mathematically guaranteed by the spread, amplified by your transaction volume. Every single one of your frantic trades contributes a tiny risk-free fraction to their bottom line. For them, your activity is not competition, it is customer flow. You are the source of their inventory. Secondly, your broker profits directly. Whether through a marked-up spread or a per-trade commission, your high-frequency activity generates immense revenue for them. A scalper who blows a $1,000 account might have paid $300 in pure transactional cost to the broker. The broker's incentive is aligned with your activity, not your success. They profit from your churn. Third, the sellers of the scalping dream win. The gurus, the course creators, the signal sellers who promise daily pip harvesting systems. They sell the fantasy of easy money to those frustrated by the complexity of real trading. Their product is hopium, and they get paid upfront while you battle the impossible arithmetic. Finally, and most insidiously, the high-frequency trading, HFT arbitrage algorithms profit. They exploit microscopic inefficiencies and latency differences you cannot even perceive. When your market order causes a tiny price dislocation across two platforms, they are there to capitalize on it in nanoseconds. Your trade is the pebble that creates the ripple they instantly surf. In this ecosystem, you, the retail scalper, are not a trader. You are the product. Your capital is the raw material. Your emotions and need for action are the fuel. Your orders are the signal. Every part of your engagement is monetized by a layer of the system designed to extract value from your participation, regardless of your P&L. Understanding this shifts the entire perspective. You are not failing at a difficult game. You are being farmed in a lucrative one. Beyond the math and the hidden opponents lies the most effective trap of all, the psychological grinder. Scalping isn't just a trading style, it's a state of sustained cognitive overload designed to exploit your brain's deepest biological wiring. It systematically transforms rational decision-making into reactive impulse, turning you into your own worst enemy. Your brain is not built for the scalper's environment. It evolved to recognize patterns and make decisions with deliberate consideration, not to process dozens of high-stakes risk-reward calculations per hour. In this state of constant pressure, the prefrontal cortex, the center for logic and discipline, gets hijacked by the amygdala, the seat of fear and panic. What you call intuition during a scalp is often just panic or greed, dressed up as a gut feeling. This creates a vicious, self-reinforcing cycle. Each tiny win releases a hit of dopamine, reinforcing the behavior, making you crave the next trade. But this reward is random and intermittent, the most addictive kind. You become a lab rat pressing a lever, not for consistent profit, but for the fleeting chemical reward of being right. Conversely, a small loss triggers a disproportionate stress response. The pain of a loss is psychologically greater than the pleasure of an equivalent gain. To avoid this pain, you commit the two cardinal sins. You move your stop loss, turning a small loss into a catastrophic one, or you revenge trade, throwing your rules out the window to get back to break even immediately. Furthermore, scalping fosters the illusion of control. Because you are constantly acting, clicking, analyzing micro movements, you feel you are mastering the market. This is a dangerous delusion. Real market control comes from patience and selective engagement, not from frantic activity. This false sense of mastery leads to overconfidence, increased position size, and ultimately the blow-up trade that wipes out weeks of microscopic gains in seconds. The end result is not just a drained account, but a drained human being. The mental fatigue from hours of hyper-focused screen time leads to burnout, anxiety, and eroded self-trust. You are left emotionally volatile and financially depleted, having confused the intensity of the activity with the quality of the work. The scalping trap, therefore, claims its final victory not just in your portfolio, but in your psyche, leaving you less capable of the very discipline and patience required for genuine trading success. So, is all hope lost? If scalping is a trap, does that mean trading itself is impossible? Absolutely not. The solution is not to abandon trading, but to redirect the very energy and discipline you've been wasting on scalping towards a time frame where the odds are not systemically stacked against you. This is your escape hatch. The first non-negotiable step is to conduct a brutal audit. Shut down your trading platform for 72 hours. Open your trading journal and calculate your all-in P&L from scalping, including every commission and spread cost. Then, divide that number by the number of hours you've spent staring at those flickering charts. You will likely discover your effective hourly wage is below zero, and the emotional cost has been catastrophic. This data is your liberation. It's the proof that breaks the addiction's hold. The next step is the great shift. Your goal is to translate the raw skill you've been honing, reading price action, managing instantaneous risk, into a more powerful context. Begin by moving your charts to the 1-hour and 4-hour timeframes. The same principles of support, resistance, trend, and momentum apply, but now you are observing the market's true narrative, not its erratic typos. Here is your action plan. Refocus your analysis. Instead of looking for 5-pip moves, start identifying key weekly and daily levels. Watch how price respects these levels on the close of an hourly candle. The noise fades and the structure emerges. Recalibrate your risk. Your risk per trade can remain the same in dollar terms, but your stop loss will now be 30 to 50 pips away instead of 5. This feels terrifying at first, but it's liberating. You are giving your trade logical room to breathe, based on market structure, not on your pain threshold. Redefine your activity. Your job is no longer to be constantly active. Your job is to be constantly vigilant for the 1 to 3 high-quality setups per week that these higher time frames provide. The work shifts from frantic execution to patient preparation, deep analysis, and flawless execution of a rare plan. Repurpose your discipline. The discipline you used to force yourself to take 50 trades a day is now channeled into a far harder task. The discipline to do nothing, to wait for the market to come to your predefined level, to watch fake-outs without flinching, and to hold a winning trade for days, not seconds. You are not stepping down from trading. You are stepping up. You are graduating from the chaotic, predator-infested shallow waters to the deeper, more powerful currents where real trends are born. The patience and screen time you once used to hunt mosquitoes can now be used to track a lion. It requires more courage, more emotional fortitude, and more intellectual rigor. But for the first time, you are playing a game where your greatest asset, your human capacity for reason and patience, is an advantage, not a liability to be exploited by a machine. This is where real trading begins. Let's cut through the final layer of confusion. You now know the trap. You see the mechanics, the math, and the mental grind. The question is no longer, is scalping a trap? The only question that matters now is, what do I do instead? Here is your practical, no-excuse checklist to exit the scalping casino and step onto the path of actual trading. Print this. Put it next to your screen. The Scalping Exit Checklist. Acknowledge the leak. For 1 week, track every trade with this single metric: net P&L after costs, spread plus commission. See the real number. This evidence kills denial. Delete your templates. Remove every 1, 2, and 5-minute chart template from your platform. Create a new workspace with only the 1-hour and 4-hour charts. You are physically changing your environment. Redefine a setup. Write down this rule. A valid setup requires a clear confluence on the 1-hour, 4-hour chart. A key level, support resistance, aligning with a higher time frame trend, and a clear price action signal, rejection, breakout close. If it's not clear on the 1 hour, it does not exist, the 24-hour rule. After identifying a potential setup, you must wait 24 hours before entering. This does two things. It forces patience and filters out impulsive noise. If the setup is still valid tomorrow, it's stronger. Measure effort versus result, the Wyckoff filter. Before any entry, ask, on the higher time frame, is the volume, effort, supporting this price move? Result? High volume plus small move equals absorption, be careful. Low volume plus big move equals manipulation or thin liquidity, be careful. You're now reading the market's strength, not its noise. Embrace the boredom. Schedule your chart review times, twice a day for 30 minutes max. Outside of those times, the platform is closed. Your new skill is strategic inaction. If you feel the itch to just look, you go for a walk. You are breaking the neurological addiction to the screen. This transition will feel alien. It will feel slow. You will feel like you're missing out. That feeling is your confirmation that you are on the right path. The FOMO is the withdrawal symptom from your addiction to action. The final liberating truth is this: scalping promised you control through constant activity, but it made you a slave to chaos. True control comes from selective, powerful inactivity. By moving higher, you are not giving up on profits. You are giving up on exhaustion, anxiety, and guaranteed mathematical loss. You are trading less to earn more. You are thinking more to click less. You have been trying to win a sprint that everyone else is running in reverse. It's time to step off that track and start training for a marathon. The market will always be here. Your capital and your sanity might not be. Choose the game where your mind is your greatest asset, not your fastest liability. Let's land this plane. You came here looking for an edge in scalping, a way to make the fast money work. Instead, you got a demolition of the entire fantasy. That wasn't an attack on you. It was a strategic intervention. The path of the scalper is a closed loop. It ends in one of two places: burnout or blowout. You either emotionally quit, exhausted and cynical, or you financially quit, your account liquidated by the 1,000th paper cut. There is no sustainable victory in that arena for you. The game is designed that way. Your takeaway today should not be despair. It should be the most liberating clarity you've ever had about trading. You now see the 3 walls of the trap with perfect vision. The mathematical wall, the spread and commission that guarantee a loss over time. The mechanical wall, the algorithms and liquidity providers who are your true opponents, not other traders. The psychological wall, the brain hijacking cycle of addiction and exhaustion that destroys discipline. Seeing these walls is not a reason to quit trading. It's your permission slip to stop playing the wrong game. The trader you were meant to be is not the one hunched over a screen, heart-pounding, chasing noise. The trader you are meant to be is a strategist, a patient observer, a disciplined executor. That person uses the higher time frames as their canvas, where their greatest human qualities, patience, reason, and emotional control, become their primary edge. In that game, the algorithms aren't your predators. They are just another part of the landscape. The cost of trading becomes a minor fee, not an insurmountable hurdle. The psychology transforms from frantic reaction to calm, planned action. This is your crossroads. You can close this video, feel a moment of resonance, and tomorrow open the same 1-minute chart, hoping this time will be different. Or you can take the single powerful step outlined in your checklist. Delete the templates, open the 4-hour chart, embrace the terrifying, liberating boredom of waiting for a real opportunity. The market doesn't need more scalpers, it has plenty of fuel. But the community of disciplined, clear-eyed traders is always small. That's where the real opportunity lives. Not in the chaos of the crowd, but in the quiet discipline of the few. You now have the map out of the trap. The only thing left to do is walk. Start with the first item on the checklist. Your future self, the calm and consistent trader, is waiting for you to make that choice today.